equities are looking a little bit better this time around. And yeah, your views first off.
Okay, this week, just like you said, it's better compared to what we'd had at the beginning of the week. First 2-3 days of trade, we had a negative close of the index. That's probably because that's one of the major reasons causing that really is because of the illiquidity in the system. And then, as you know, during the week, interest rates were hiked up. So some yields of some fixed income securities would, of course, that have positive relationship with this rate would also go up, and that makes it more attractive. So you want to think that some investors who want to diversify, or who have a diversified portfolio would probably get out of some of their positions at marginal profit, and then key in at the increasing yields at short-term end of the fixed income market. Also, it's also month-end, so we've seen some investors take their profits. Some speculators, of course, think that this will be the best time to come in also. So it's all in all, it's a very, very active market, and it's a sign of a healthy market in that the direction is not just going one way. We see buys and sells at the right prices.
How do fixed income compare to equities? I'll tell you why. Obviously, before elections and all the political issues, investors were a bit jittery, and apparently many of them flocked to the fixed income side looking for safer assets. But now that the political situation has abated and we're going to get a new administration with a new cabinet, there's a sense that people will start to look at equities because there's just a general sense of what the climate is like. Is this a foreboding for fixed income assets?
Okay. Basically, it was about risk before the elections, and right now that the elections have been peaceful, handover is this weekend, we're going to see more activities on the equities market. But it won't be a massive pullout from the fixed income market, because apart from it offering us very good, zero risk, we know that the yields are quite very attractive. During the week when rates were increased, the MPR rate was increased in the interbank, the yields that T-bills auctions were stopped at were not actually, commensurate to the increase of the rate. Basically, what I'm trying to explain is that we didn't see that hike in yields in the T-bills auction because there was great demand. So it's not just about risk-free. What we've seen is that at these yields, the short fixed incomes are quite attractive. So we won't see people flocking out back to the equities market like that. But basically, both markets are going to be very, very active, especially for people who've got diversified portfolios.
The decision by the CBN's Monetary Policy Committee to raise interest rates to 8%, how has that impacted the money markets and also the bond markets?
Okay, basically they are continuing what the strategy they had adopted in the last 4 months. We've seen interest rate go from 6.5 to 7.5 and then 8%. Basically, they are very serious at trying to curb inflation. Inflation had dropped about 150 basis points, but despite that, they have not relaxed. They have continued to tighten up liquidity. Basically, the pros is that inflation will be kept at bay. The objective is a single-digit inflation level. That's where they are going to, and that's why we're seeing them continue to tighten on level of liquidity. But there are fears and concerns here and there about the level of activity that would happen, or the impact that will have in the money market, the influence that will have in that rates will go up, and then you would see more investors taking their money off basic fixed deposits to fixed income, whose yields have continued to go up. In positive relationship with the policy rate that was released.
I mean, talking about fixed income as an asset class, obviously with rates rising, for those who have inflation-linked assets that they've invested in, the question is the kind of interest payment and coupons they'll be receiving during the course of the year. What do you make of, what do you think those rates could be given the rise in interest rates?
Okay, most bonds that we have coupons usually. The coupons will usually be paid twice during the year. The coupons are fixed amounts. Basically, what will change are the tradable yields in the secondary markets. So for speculators and people who go in on the short term to take position, that it matters a lot. But if you're buying for holds to maturity, your coupon will be steady at the initial coupon at which that bond was offered. So inflation rates and increase in rate may not necessarily affect the coupon payment, but the yields, the tradable yields and prices of this instrument at the secondary market.
Right. Okay, and just talk us through the results of the primary T-bill auctions this week.
Okay, there was a primary auction midweek. We saw 91 and 182-day T-bills being issued. We saw yields stop higher than what they stopped at 2 weeks ago, at about 20 basis point increase. That is not commensurate to the increase in rates as released by the MPC. So, I mean, there's a gap of between 50 basis points and the average of 20 basis point increase in yield. I mean, it just shows that these bills are quite attractive. And then on Thursday, that's a day after the primary auction, we had another open market operation. The CBN actually came in to mop some more funds and issue more bills of 2 different maturities. The objective being what we had discussed earlier, tightening the liquidity level, keeping inflation at bay, and that's working. I mean, if you want to look back the last few months.